Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today on our call, we have Steve Levely, the CEO of Ackroo. Ackroo trades on the TSX Venture Exchange under the symbol AKR and on the OTC under AKR-FF. The company is trading at 14 cents with roughly 77 million shares outstanding, or about an $11 million market cap. I'd now like to hand it over to Paul Andriola.
Thanks, Trevor. Steve, long time no see. Great to have you here. We've been following Ackroo for a little while. A number of our subscribers, our shareholders, and are constantly suggesting that we give you a call and have you do one of these presentations. So I'm happy we finally got the opportunity to do it. Why don't you tell us all about your business? And I understand you got a presentation. So what I'm going to do is I'm just going to hand it over to you and give you the chair here for the next 20 minutes.
Sure. Yeah, I'll drive through things, and I think where it starts is the name Ackroo. What it really is we spelt it funny on purpose. ACCRUE is the correct pronunciation, but we kind of stole the two O's from Yahoo and Google and thought spell it funny. But really, what we're doing is we're trying to accrue companies. We're a consolidator, right? So it's accruing. It's vendor consolidation for merchants. It's accruing companies in our industry. But unlike a Constellation software that would just buy companies and they operate them, we operate what we're buying. So we're a single operator where, yes, we're consolidating the marketplace as best we can, but we're doing it as an operator first. So if you think about fundamentally what we've done is we've gone to the market saying, look, we're going to try to consolidate both for vendors. So if you're a restaurant or a retailer, we're going to consolidate all the vendors you deal with, primarily for things around payment currency and what have you, while also consolidating our industry. So it's a consolidation play both for our vendors and for our industry. And so we've done that over a period of time, and what we ended up having happen to the business is we actually got a bit diversified. So initially we were in, coffee shops and car dealerships, but as time's gone on, we specialized a bit more. So we kind of went after four key verticals: automotive, petroleum, hospitality, and retail. And by diversifying across these four verticals, it's helped us through times like COVID, where a third of our revenues are in the areas of automotive and a third of our revenues are in the area of petroleum. Well, gas stations and cars, they're still moving through COVID. So that diversification has really helped us. But fundamentally, what we did as a business is we began consolidation as a gift card company first, got into loyalty second, then got into marketing. So think email marketing. Then we had to get into data, so all the data from loyalty. Then we get into payments. So similar to the Lightspeeds of the world that added payments, a lot of our partnerships came through payments. And then most recently, literally last week, we took over a point of sale company. So for us to sort of take over the whole ecosystem itself. I'll talk a bit about more of those in a second. But really what we're doing is we're trying to be a technology first company that has a self-serve marketing platform to manage these currencies like gift card and loyalty and promotions. We want to be able to integrate to other applications like POS companies like we've just acquired. But everything's about the data and the data that we have. So we want to be a data-driven business for both in-store and online retailers. So how do we do it? Today, our technology kind of does three things. One, it does all the processing at the point of sale. So it's capturing all that transactional data at the point of sale. We then take all that data and it goes into what we call our program console, which is kind of the brains of our product that runs all the marketing and administrative data. Then we have all these customer-facing apps, so mobile apps, going to people's websites to check and transfer balances. So that's what the tech does. But we also provide a lot of services today. So we do distribution services, which is selling gift cards and other marketplaces. We're into BI and data. We're into marketing services like email and direct mail marketing. We have point of sale and payments. What we're doing now with our business, though, is we're taking all of these services and we're embedding them in our tech. So instead of having us do an email marketing service for you, do your emails through MailChimp and what have you, we're embedding that technology into our product. Instead of doing BI for your business outside of our technology, we're embedding it into our technology in order to build like an ecosystem of knowledge that's there. From a revenue perspective, we've done well. The business started in 2012 through an acquisition. We bought a company called Money Bar out of Vancouver. It was about a $500,000 business. So the first year was just about validating the business. The second year, we did double the revenues, but it was massive scaling. Went from a 6-person company to a 46-person company. Blew out all the initial cash that was raised when we went public that first year. So it was $8 million went into the business the first year. 6 was spent in the very first year alone. So we stretched that second year. So in the third year of the business, some tough decisions were made. The CEO then stepped down. The board tapped me on the shoulder and asked if I wanted to take over the business. So in 2014 is when I took over Ackroo. And at that point is when I stepped in to kind of, change the commercial model, so moving back away from a direct sales model to a channel sales model, and to move more to a consolidated approach, so acquisition growth. So we focus a lot on our inorganic growth throughout the years. There's always been some organic growth called single digits, but the bulk of our growth over the years has been through acquisition. We've now bought 10 companies through our journey, and you can see how what it's done well for us from a growth perspective with regards to our revenues. We've naturally gone through an EBITDA story the same way, where again, I took over in 2014. So in 2015 is actually when a lot of your, you mentioned earlier about you have some of your members or subscribers that are shareholders in Ackroo. It's actually in 2015, in January 2015 is when we did our first financing that group participated. So that's the point when we had a number of your subscribers start participating. So they've seen the journey go from losses to in 2018 we got into earnings, and now we continue to see that earnings growth for the business. So they kind of hit us a little early, and hopefully we're going to see some big returns from them over time because of it. So I think our metrics are pretty good. You know, we've been running about a 34% CAGR business on revenue. We're up to 84% of our revenues recurring. It's very high right now because our one-time revenue was a little bit lower since COVID started. So people buying cards and plastic, and I'll talk about how our revenue works in a minute. But our recurring revenue percentage is really high. Our gross margins are high because of it. Our EBITDA has been growing. And what we've been trying to run is a 20% EBITDA business. So for every dollar of revenue, so for a $6 million business this year, we expect to have a $1.2 million earnings business. And we think we can continue to maintain that as we kind of move forward while we're kind of growing our business. The other thing that's important about our business is because it's been very sticky. So a part of why we're doing a lot of acquisitions is our retention rate's really high. Even through COVID, it hasn't been that bad. Our retail business got affected, but everything else has been pretty static. But for us, it's just as it's sticky for our clients, our competitors, it's just as sticky for them. So getting these big clients, you need to acquire them. It's not so simple organically. Inorganically is how you're doing a lot of that customer acquisition for the bigger brands. So that's where that whole M&A piece has sort of played well for us. I mentioned a bit of our story around, the first year we went public and rebuilt the whole technology, and then I took over. Then it's been a lot of acquisition growth for the business and focus. We've done 3 this year. It's been a busy year. We've done 3 once before, but they were all strategic in nature. So when I think of the market, this is how I describe it. The ecosystem themselves, we started out as a gift loyalty provider. We got into marketing and data, and most recently into payments and point of sale. But really the heart of our marketing technology is data. So we have a data hub, which is this marketing hub, and then gift and loyalty and point of sale and payments and marketing all feed this. And if you really think about it from a technology perspective, there's actually 3 parts to Ackroo now. We have a payments business because we resell payments. We have a marketing platform, and now we have a point of sale platform. So there's 3 different components to the business, but that marketing platform, which is what we're known for today, it's all about a data-driven approach to the business where we're having a lot of BI. So we've actually got a third-party BI tool that's now embedded into our technology. So when you join the Ackroo network, you know not only how good I'm doing from a gift loyalty perspective, but actually how I compare to others on the Ackroo network. So there's a whole network effect of data that we've now created with our business. From addressable market, we've done really well in 2 specialized verticals, both in automotive and petroleum. 1 in every 5 car dealerships in Canada uses our software. 1 in every 11 or 12 gas stations uses our product. We've got a smaller market share in areas like hospitality and retail because that's where a lot of our competitors play. But we have 2 niche verticals that we've done really well in because of some customizations and partnerships that we've created there. Lots of benefits to, gift and loyalty and marketing platforms and point of sale, all for different reasons. The point of sale step was all about the operational part of the business. It's that core operational piece we wanted to sort of bolt in last. So that was a part of the strategy for that acquisition. Where our sweet spot as a business is, we started out as kind of a small player, and we're actually over 5,000 locations now after that last acquisition. So we're 5,000 plus locations now. But we've got a mix of large brands, small brands, and medium brands. And I'd argue our sweet spot is the mid-sized brands. This is the clients that need the most out of our technology and services. They pay us the most revenue per location. It's these mid-market clients that we've done the best with. Don't get me wrong, the bigger clients are great for us. They pay a lot of bills and they're important. But really where we feel we bring the most value today is these mid-market merchants. We've done it through lots of partnerships. So partnerships has been the key for Ackroo from an integration and a commercialization standpoint. Because yes, we need to communicate to all these different point of sale systems, and every quarter another one grows, like Lightspeed's a recent one that we just did. We're always adding more and more every quarter. And so this has been the path for scale, not just from a technology perspective, but even from a lead generation. But fundamentally, how we make money is we make money through a monthly recurring fee primarily. So what we'll do is we'll charge customers a one-time setup fee. And they'll pay us anywhere from $250 to $1,000 a location to get set up, buy their initial cards and what have you. Once they pay that initial setup fee, which is our one-time or product revenue when you see our financial statements, they then go into a monthly subscription. And they'll range from low at $25 a month to $500 a month, where right now that average is 83. So if we had all of our clients maximizing the monthlies, our revenues would be 5 times what it is. You see companies like Quorum that are out there, and Quorum has 1,000 locations, and they have a $30 million business. Ackroo has 600 car dealerships, and we're only a $6 million business. So it just sort of shows what the revenue impact is per client if done correctly. So for us, a lot of the upside is in the other places. We have a variable revenue opportunity through payment and specialty commissions that we get, but we only get that from 7% of our customers. So only 7% of Ackroo's customers we're making payment commissions off of. So there's 93% of our customers we can cross-sell and upsell to payment to. It's a big opportunity. Only 10% of our customers are doing marketing services with us. So there's 90% of our customer base that we can upsell and cross-sell to try to close that $83 to $500 gap. So there's a lot of cross-sell, upsell opportunity for us within our own base, never mind adding new customers or acquiring new businesses. So our approach is kind of threefold. It's cross-sell our base, add more product partners, and do more direct sales. So it's taking our gift card customers to do digital gift cards, to do promos, then loyalty, then more marketing, payments, and point of sale. Our technology strategy has been simple, but expanding our product, integrating to different solutions, but centralizing it as best we can. We're heavily dominated in Canada. Over 90% of our revenue is Canadian today. 10% is US. So how do we change that mix? So there's a big US opportunity for the business as well. I mentioned earlier, we've done 10 deals, and you can kind of get a feel of what we've been paying. We've been paying on average about 2 times revenue. And then from an Ackroo standpoint, about 40% of all revenue purchased ends up contributing to EBITDA afterwards. We always aim for 50, but we've been averaging about 40% contributed to EBITDA after every deal is done. So we're pretty much paying 2 times revenue, 4 to 5 times earnings on all the deals that we've done. But every one of them isn't just about buying customers and revenues. And regardless of how we structure the deals, it's more been about intrinsic value. So we want to get into gift card fulfillment. We want to get into automotive. We want to get into mobile, petroleum, digital marketing and BI, payment, and now POS. So there's been a lot of strategic reasons why we've done each deal to kind of expand the breadth of our offering and to kind of, that whole accruing of offerings has been really important for us. So every deal we do is not just good from a dollars and cents perspective. It's strategically aligning with our vision to how we're going to scale our business. So inorganically, we plan to continue down this path where we'll probably acquire 1 to 2 per year. We did 3 this year. It doesn't mean we won't do 3 or 4 in future years. A lot of our acquisition time is our goal is to buy a company within 12 months, normalize them. So you really can't do too many when you've got a small business. And as we're trying to grow an organic business, the more we do in a year, the more that slows down the organic growth. When your whole business is wrapped around inorganically integrating and normalizing, it's hard to focus organically. So we're trying to sort of balance that as best we can. But again, it's a very fragmented marketplace, lots of players out there. When things like COVID happened, there were more people knocking on my door than there were before. Our funnel is grown bigger than it's ever been with regards to opportunities for us. It's just a matter of reeling in these deals for us. And a part of the financing that we just did and we're closing, very soon was to do acquisitions like the POS acquisitions. So our future financings will be for acquisitions. We no longer need it for working capital purposes. It's all about financing for future acquisitions that are accretive for us. And so that financing we just did, the $3 million we put into the company, it helped us buy GG Golf, but it also provides us the rest of the capital to do the next deal we're going to do probably in the new year. So it's affording more acquisition capital for the business. Lots of players in this space. I kind of break it into 4 quadrants. You have the gift loyalty guys, the marketing guys, the payment guys, the point of sale guys. Ackroo plays in all of these places today. And there's lots of companies in each area. Everyone's either competing, consolidating, partnering. It's a very busy ecosystem that this whole industry is just coming together as one. There are some public market peers that I think are good to talk about. Aimia is one that people know about because of, Aeroplan. But, we're not the brand. What's different about the Ackroo merchants is it's their own brand. So it's not Air Miles or Aeroplan. It's their bonus bucks program for their business. So that's where it's different for us. It's for their branding. It's not the Ackroo branding today. For Lightspeed, they focus specifically on POS first, and for just hospitality and retail. They don't play in areas like automotive and petroleum like we do. So they've picked 2 of our 4 verticals that they're focusing on and doing well in. And they're doing very well there, but they're in only 2 of the 4 verticals that we play in. Shopify's taken a very e-commerce approach. First, they've gone in-store second. And so for them, we actually see them more of a partner than a competitor, because they're actually playing into more of the micro merchants. You don't really see Shopify heavily for the in-store brick and mortar businesses that we're heavily known for. All of our clients are brick and mortar first, e-commerce second. We don't have any customers that are pure e-commerce at Ackroo today. All of our customers are both omni-channel. They're both brick and mortar plus e-commerce. PAR is a great POS company out of the States, very focused on hospitality and retail. So again, 2 specific verticals, not all 4. And then Quorum is specifically focused on automotive. So lots of guys that are doing similar things, and they're even consolidating like we are, but they focus on similar verticals. Perhaps that's a better strategy for them. It would have been a better strategy for Ackroo short term, but we believe long term this diversification is going to pay us really well. So how do we differentiate? You know, we're focusing on vendor and industry consolidation for all these merchant sizes. We've gone after these 4 verticals. We've taken this data-driven self-serve approach. It is a channel sales model with technology first and services second. So we're not like a marketing firm that sells all these services. We're a technology company. So who and how we partner is really important. We are Ontario and Hamilton based, North American focused. But I think what's also unique is our public currency. There's not a lot of public companies in our space. Like I know I named a few of them before, but if you look in that slide, there's not a lot of public guys that do what we do. There were very few and far between. It's a very private ecosystem. So there's not a lot of investing opportunities in our space unless you're going to the really big companies. So I'm also able to kind of pick up a small gap of the acquisitions where these less than $5 million revenue businesses, the big guys are not buying. So there's this small area I can kind of gobble up because it doesn't move the needle enough for them. So the guys that are public, that are in my space, they're not competing with me on these deals. When I bought GG Golf, Lightspeed was not upset. They bought Chrono Golf before. Yes, they have a golf business, but they weren't fighting for that deal because it's less than that $5 million market today. So we've got that little niche down there that we're chewing in on. For me, I think we've got some market leadership in a lot of ways. Yes, we're SaaS, we're omni-channel, we're payments, we're big data. Our revenue growth and recurring revenue, I think, is strong, and earnings growth are good. But I think it's an attractive valuation. You know, we're at about 2 times revenue and 10 times EBITDA today is where we're kind of trading. And so, you know, knowing that we're kind of buying with what we're trading at, it says that we're kind of somewhat aligned, but we have big aspirations for growth. And I think our growth should be driving potentially a bigger valuation for the business in the future. This is our share structure today. There's 77 million shares issued. However, this financing is going to issue another 25 million shares. So we'll be at 100 million shares once the financing closes in the next few days. So that'll be our total issued and outstanding. So our market cap will be more around the 12-cent range, is where it was when I did this deck, the 12 to $13 million range, which again is in that 2 times revenue, 10 times earnings multiple. And our team really consists of 3 of us at a senior leadership perspective, and then our board of directors. What helped with the Shens getting involved, they've actually become an extension of our executive team, mind you. So they brought an advisor group. It's not just the Shens themselves that are affiliated. They actually put together a fund. So we're now their 3rd acquisition, or their 3rd investment that they've done. Vital Hub, Media Valley, the first were the 3rd. But they've actually now introduced a group of advisors that are involved. And it's out of a fund now. It's not the individuals anymore. So they have a number of advisors that are involved with the business. I even had a meeting this morning with them where they're actually going to actively involved in helping to grow and drive and guide the business. So that's my fast and furious 20-minute deck flip for you, Paul. Does that cover a lot of it?
Absolutely. We love it when you guys give presentations because it makes my job easy and I don't have to ask nearly as many questions. So good for you. Yeah, I'm glad. Why don't we sort of start with the last couple of things you talked about? I'm glad you brought up the Shen family, what they bring to the table. We certainly have seen what they've done with a couple other companies, but how important is it to have that kind of financial backing for what you guys do? I imagine, you know, having to sort of go hat in hand for years raising money is a little different when you have somebody of that stature in behind you. Does that give you more confidence to go out and do acquisitions?
Well, yeah. So, I mean, I look at them as 2 parts to why I like them. They really are sponsors, right? They're saying, look, we've got a capital, and there's even a group behind them after them that's lined up behind them when they run out of their access to capital. So I don't have to chase capital anymore. the capital markets piece of it and being able to raise capital, which has been very difficult and challenging. Like when you're a microcap that's as small as we are, that's been fighting through, losses to earnings, it takes up a lot of effort just to sort of get the drip capital into your business. So they kind of relieve all that pressure from an access to capital perspective. When we have a deal we want to do, I don't then have to worry about going out and getting the capital. And when I'm negotiating with an acquisition, like even some of the deals I was trying to work on this year, the targets would say to me, get the money first, then call me. Now I can say, I've got the money. It may not be my treasury today, but here's who's sponsoring us and the capital is there. So it actually expedites even the acquisitions fee for these bigger and better deals. So it's a big win there. The other is the advisory part. They've been through this before. They've helped these other companies sort of see success. So I actually see them helping us commercialize better, do deals faster and better and all that good stuff.
And why don't you walk us through what it looks like to actually fill your funnel with acquisition opportunities, and then walk through a deal? Do you call them up on the phone and say, "Hey, let's buy you guys"?
So a lot of it is you partner with everybody, right? Mm-hmm. So you're always partnering. So what's been good for Ackroo is that two things are happening. One, we're having to partner to grow. So, and because we're getting complementary, I'm already talking to these complementary companies to partner with them anyhow. And then when we start having a partnership discussion, then we instantly get into, well, I know we talked about partnering, but would you sell? We're looking to either double down in your part of the business, or we're looking to get into your part of the business. Is there an appetite to sell? And that turns into, well, actually, now that you mentioned it, yeah. And this is what would happen if I was to sell. So that's an example of where M&A comes from. So we're having partnership discussions that turn into acquisitions. But I'm also targeting direct competitors and saying to them, here's what we're doing. Let's just learn where we all play in the ecosystem, because it's a big marketplace. Let's just know where we're tripping over each other, because we all kind of have niches that are stronger than the others. And then in those discussions, they all know I'm always looking to, consolidate. So if they're ever looking for an exit, we're a path to them. And that's kind of become known. So our direct competitors know that we do it. A lot of them call me before I even call them now, because they know that we're doing it. And then complementary wise, we're always partnering. So then the complementary discussions come up through partnership. So the M&A funnel just continues to grow. But we're also now tied into, like this last acquisition, it wasn't PR'd, but they were owned by Valsoft. So if you would have done the homework on GG Golf, they were owned by a vertical market software company, Valsoft, who buys all these software companies. They're now another M&A channel for Ackroo, where any of the businesses that they acquire that actually require an operator, not just an owner, it becomes a better path for us to take those businesses over for them as well. So there's a whole other now vehicle for M&A for us.
Fantastic. So, you've really broadened your platform of technologies and services, everything from POS to, loyalty and you name it. But are there other technologies or verticals you want to sort of move into and acquire?
No, I just want to double down now. At this stage, we're wide as we want to be. Now we got to double down on each of these pieces. So how do we double down in each of these areas in a much more, material way? So that's kind of the next thing for us.
Gotcha. And then typically, if you're gonna double down on a company that's sort of your competitor or your semi-partner, what do you look to extract out of them as far as synergies? What are you you cutting out the accountants? You getting rid of sales channel? Where do you typically get your savings?
So it's always HR savings is the first thing, right? So the HR savings, I'm just plugging in my speaker here, but. There's definitely HR savings every single time. Obviously we run our own business. We don't need all the staffing, but so there's always a staffing savings. So definitely in finance is where you see a lot of it, to be honest. On the engineering side, you'll keep the key engineers, but on the sales and marketing side, you're just usually keeping their best people. So you're kind of taking the cream of the crop, and fundamentally we usually keep half the staff, but we haven't even been keeping half the staff over the years. It's been less and less. So there's a staffing savings. There's an operational advantage. So from a hosting perspective, the actual cost of hosting, even though it's small, like you see where 89% gross margins, there's still a 10% cost that you can save on, right? So there's 10% there, and then get another 30 or 40% through staffing, and you have your 50% contribution.
Okay, perfect. I'm going to remind everybody, if you guys want to ask any questions, feel free to use the chat function, and just let me know what I need to ask Steve here. You're a small microcap company. You've been sort of at this for a while. Maybe tell us a little bit of the challenges you're facing right now, or maybe you're not anymore, but investor relations wise, how does a small company like you get out there and properly tell your story so that everybody understands what you're doing?
I think it's still hard for us because of our size, right? I think it's for us, the things we used to lose sleep over was, I felt like, we don't have a lot of executives at Ackroo, so we wanted more executive support. So that's come. It's always been challenging to raise capital when you're small and what have you. So now those issues and challenges are gone. So M&A and stuff will be easier. So I believe the inorganic and organic business gets easier because of what we've done over the last 12 months. But what's still hard is capital markets exposure. Like, we're still a small microcap. This group is not looking to do a lot of, awareness and publicity, because it's not what they do. They just hope that people will understand the progress of the business, and the shares will take care of itself. So there isn't a big promotional strategy today for the business. But when you're a $6 or $7 million business, doing 1.2 to 1.5 million in earnings, like, it's until our market cap gets to 20, 30, 50, $100 million, we're not hitting a ton of radars of analysts, not hitting a ton of radars of institutions. So it's at some point we'll start to cross that. And I think that's the next thing. At what point does our business start hitting, from a market cap perspective, that it hits a radar of more institutions? And I've actually been told it's less to do with our revenues and earnings, because they believe we're doing a good job from a growth perspective. It's more just the market cap itself. So as we get more buyers interested in being owners of this company, the shares will appreciate, the market cap will appreciate, analysts will see it, like, this bubbling will happen. So that's what we've got to try to figure out, is how do we get more awareness and get more people interested in getting a position in Ackroo, get more owners in our business to help us on this journey.
Yeah. And to that end, I think you'd mentioned that 50% owned by insiders. Is that correct?
That's right. Yeah.
Give me a rough idea of what you think the other 50% is. I mean, I see that Jason Donville's a director. There can't be that much institutional ownership in a company this small.
There isn't. So it's actually even 70% is actually insiders now with the Shens, because the Shens are going to take 19% of the business. So we're up to almost as high as 70%. So you've only got a 30% float out there. That's really out there. So that's what the float is at this stage, right? So you got kind of 70% is tightly held, and you'll have 30% floating.
Yeah. Yeah, that certainly is going to help. But I agree with you. I think there's a lot of issues of being a small company that just doesn't give you the institutional or industry awareness, simply because you're not on the radar screens. And
you're also not putting a lot of time and money there, because you got to operate your business.
Well,
like, like a CEO of a larger company, they're spending a huge amount of their time on, communication and awareness and all that kind of good stuff. I don't spend, it sounds terrible, but I spend extremely little amount of time on it. And maybe it hurts us in a way, but right now what's been way more important is that I have a really strong operationally run business, and that's what's grabbed my attention.
You sort of mentioned there's a lot of fragmentation in the different sort of verticals that you're in. How much of your time is spent looking at all these deals that are out there? Is that the bulk of your time right now?
I'd say I'm always 20% of my time, I'm always looking, but then when deals happen, it takes up about half of my time. So right now, half of my time GG Golf is getting, because the deal over the last few weeks, between getting the deal done and getting them normalized, it's taken about 50% of my time. But once that normalizes out, it's about 20% of my time. So I'm about 80-20. When the deal is not happening, I'm 80-20. When the deals are happening, it's 50-50.
Right. And refresh my memory again. How many deals have you done so far?
So we've done 10.
10
over the last 6 years.
Yeah. And what have you found that's worked well, and what have you found that hasn't worked out well? And not necessarily the deals, but like the different pieces. There's so many moving parts of these things. What's worked well for you guys, and what do you have to improve? So
one thing that's worked well is two things. For the most part, we've acquired businesses that the owners didn't come along with it. So that's an important thing, where we don't have extra cooks in the kitchen. So every time the owners themselves are either looking to retire, looking to move on, whatever, we haven't had to try to figure out how ownership is going to play into Ackroo ever. All of our deals, the owners have never come along. So there's been that's been an important thing for us, where you haven't had this odd relationship about, that we're their boss now and all that kind of stuff. So we haven't had owners come along with it. It's been one thing that's worked well for us. The second is that for the most part, other than a few exceptions, most of the time the tech we've acquired is behind us, meaning that we're able to kind of buy technology, and you don't have to go through a year of development just to be able to catch up to what you bought, right? So the ones that we bought where the technology is behind us has bode really well. Where we've struggled is the few that we've done, the technology was in front of us. And that's where we've had a few of them. There's been 2 or 3 where we've been chasing our tail. It got really expensive. And like years ago, I'll tell you one company called Dealer Rewards that we bought. It was painful for us because we were constantly chasing the tech and we didn't own it. So it costs us a lot of money. So when we're buying businesses that, yes, you want to push the tech forward, but you don't want to be too far forward. We have all this development to do, because what we do is we buy the company, we advance our own technology, then migrate them over. So it's one technology, not multiple. And so when you're doing that, if these technologies are all further ahead of you, it takes you a long time to bring them to one. And that's fragments your own business. So that's what we've kind of learned through the process, is try to buy things that are similar to where we're at from a normalization standpoint while stretching our business. Definitely don't take the owners. As much as I know there's some talent that's there, what we want talent-wise is middle management and frontline staff. That's where we're looking for some stronger talent, because you don't want these multiple cooks in the kitchen. So those are some of the learnings that we've gotten from it.
Gotcha. Now you mentioned sort of a total addressable market of $180 billion. Ackroo's not going to obviously grab a massive lion's share of that, but no. How big does Ackroo get? Where do you see this in 5 to 10 years if everything goes right?
So for me, I mean, it's funny, like, the Shens, for instance, talked to me about, is being bigger than a Lightspeed possible? And I said, sure, anything's possible, right? They're a multi-billion-dollar company. These are all things that are possible. Our short-term goals aren't to get to there per se, but that could be the end result. I think it's very possible that we're able to go from a $6 to a $60 million business. And then the market cap off of that, we'll see what it looks like. But it's very realistic to see our revenues be 10 times the size within 5 to 10 years from now, right? We've already taken in the 8 years we've been here, we're 10 times the size of what we started. There's no reason why over the next 6 to 10 years we're not 10 times what we are today. So that path can easily happen. That I strongly believe that in the next 5 to 10 years we will for sure be 10 times the size of what we are, if not more. So there's an easy path to get there with trying to under promise and over deliver. I think that's a very realistic goal for ourselves.
So we've got 77 million shares outstanding. What do we have as far as warrants or options?
So we'll be at 100 million once this financing closes. So we'll be at 100 million outstanding once the financing closes. There's 10 million warrants outstanding now at 10 cents from a financing 3 years ago. So there's still 2 years left on or a year and a half left on those. And then there's then with this financing, there's another 25 million warrants that'll be outstanding at 18 cents.
18. Okay, gotcha. Good, fair enough.
So for us, it's a big share count, right? So what do you do with that? And do you roll it back? Our thought is no, we don't have intentions to roll it back at this stage. When I took over, that's the first thing I did. I rolled back the shares, did a financing, the microcap club participated. Like when I started the company in really 2015, and like when we restarted the whole thing, I already went through a rollback. I don't want to do that again. If anything, when we get to a point where we can't allocate our earnings towards an acquisition, we'd probably do share buybacks, right? I wouldn't do dividends. I'd rather, that's just me personally today. I'm not a big dividend guy. I'd rather reinvest in the company or buy back some shares if the price of the shares are at a price that it makes sense. So that's where we could potentially see the share count go down.
And Steve, is this a company you're going to be running in 5 to 10 years, or is the idea to sell it off to some other bigger player at some point?
When I look in the mirror, I think when, in 5 to 10 years, when we're that $60 million plus business, I think that's when we become an attractive buy for these bigger companies. And at that point, that's when they'll be knocking on our door. And that's when I can have a personal decision. I think the exit for Ackroo is getting acquired by one of these larger companies. That's why when I say, will we become a Lightspeed, a Shopify? I don't think so. I think what'll happen is one of those organizations will acquire an Ackroo. I think they'll be the ones that'll be one of the people that'll acquire us down the road in 5 to 10 years time when we have that critical mass, where acquiring us really does move the needle for them.
Fantastic.
Yeah.
Listen, I think it's a very sort of clean and easy story to sort of hear and tell. So I think we've covered off most of the questions I have, certainly. Why don't we sort of leave it with you giving us a sort of a final message or something that investors should really take away from this presentation, or something they should look forward to over sort of the next 6 to 12 months?
I think the big thing is like, this last step into point of sale, like I've been drawing this pie for a while, these 5 pieces for a while. And, and now that we finally got this last piece, now keep in mind, why the golf one happened is just because I wanted a niche. I saw value in niche markets. Golf boomed through COVID. So I thought, this is a safe one. This is as safe as they're going to be, right? Their actual business grew through COVID and all that kind of stuff. And, there's not a lot to do through these things. So we took a safe choice in the point of sale, but it's watching us double down. So we kind of have the pieces now, and we've got a very strategic plan to double down on all of it. I have M&A funnel across all the pieces happening in tandem right now. So now that we've got the right financial sponsors behind us, it's watch us double down and watch what doubling down, what it does for us, not just inorganically, but organically for this business. Now that we have all the pieces, I think we're going to see a much bigger change in the financial statements in 2021 and onwards, because we finally have the pieces of the puzzle. So it's not just, yes, we got some capital and yes, we got some backers, but we actually have finally our accruing of technology is finally here to double down on. So this whole thing we've been working at for years, we're kind of at the apex of this right now. So now we should see it all start to really flourish for us. So that's the exciting part for me, and why I still have, it's been a difficult journey to get here, but why I still have gas in the tank is knowing that, okay, now we're here and now we should be able to do something really impressive. And that's what's in front of us.
Absolutely. Steve, I've been watching you for at least 6 years now. Congratulations on surviving, but now thriving. And congratulations also with some of the capital sponsorship you're getting right now. I think that's great for a company of your size. Again, thank you for spending time with us today. We're certainly going to continue to watch what you guys are doing, and we look forward to the opportunity to get updated off your next quarter or next material bit of news. So appreciate you being with us today.
Thanks for having me, Paulie. I've enjoyed the conversation.
Excellent. And listen, if somebody wants more information, what's your website address?
So www.ackroo.com. So AKROO.com.
Perfect. And
I'm super available through email, so it's a great way to ask questions and just email me that way.
Perfect. Excellent. Great. Well, let's wrap it up. Trev, I'm going to pass it over to you.
Thanks again, Paul, and thanks again, Steve, for joining us today. Once again, that's Ackroo, AKR on the TSX venture. Thanks again, Steve.
Okay, guys. Good talking to you. Take care.
Bye now.